Greetings and welcome to another edition of the at Astra Kansas Money Talk podcast. I'm your host, Joe Blubon. I'm joined by Bob Schwartz and Mark Johnson of Bob Schwartz Financial. They have offices in Victoria, Kansas and Silver Lake, Kansas. And if you're watching us on YouTube, we'd appreciate it if you give us a thumbs up, subscribe, hit that notification bell. If you're listening to us on a podcast, give us a review. We would love to hear from you on that. If you're joining us for the first time, we like to talk about things that impact wealth and money in Kansas. And sometimes we have topics that are very specific to Kansas, and sometimes we have topics that are, pretty much universal no matter where you live. And today is one of those days where we're going to talk about a universal topic, kind of a really basic topic, and it's why you should invest. And, one of the things, Mark, that you sent me as we were getting ready for this program is just the power of investing and time. And you kind of gave me that hypothetical, just $100 invested in 1980 today would be worth $7,000. That's an amazing, just kind of amazing when you think about that. So obviously time makes the biggest difference, and we're going to talk a little bit about that today, kind of the power of time in the market, the power of compound interest. We kind of talked about this on our last episode, inflation, but that works that direction as well. Yep. So there's some power there too. So maybe take a bit of time to start us off and tell us a little bit about why time in the market is such an important part of investing.
Yeah, the biggest thing, talking about this, coming into a new year is really important because, there's going to be a lot of people that, their goals are maybe to save some more money or to invest more. And we just want to really step back and be like, okay, why should you invest? What is the driving force behind what we do?
What's in it for me?
Well, what's in it for us? What's in it for you?
Well,
okay. Yeah.
As an investor, what's in it for me?
Yeah. Why is it so good? Okay. And, Joe gave that hypothetical. If you just put $1,000 in the S&P 500, if you just put it in the S&P 500 index fund and let it roll to today, it would be $7,000.
$100.
Oh, sorry, I said 1,000. Sorry, yes. I meant 100. Yeah, that's my bad.
Yeah,
but
okay.
Yeah, $100, even better, a lot better. I was like, I thought that number sounded low, but that should tell you right away how powerful investing can be, because that went through multiple ups and downs in the market and still ended up,
It's the price we pay to get those returns, and that price is volatility.
Yep.
And you brought up that $1,000 investment. This might be a good way to demonstrate just how important time is to that. So $1,000 invested over 10 years, and we've got some numbers here, and we're looking at an 8% return on this, a hypothetical 8% return. So $1,000 invested in 10 years would turn into, $2,150 or so?
Yep. What
happens, though, once you get to 20 years, Bob?
Oh, you got $4,660. So, yeah.
It's that power of compound interest. And then when you start looking at 30 years and 40 years, that hypothetical $1,000 investment at an average 8% return over 40 years turns into $21,000 plus dollars.
Right. It's
an amazing way to look at it. 10 years, $2,000. 40 years, $21,000. It really the power of compound interest is pretty amazing.
And the thing we have to tell our kids, the thing that we have to help our young people understand is 40 years is not that long. And if you take a high school student or a young college student that has a job outside of going to school, and if they can save $50 a month for 6 months out of the year, and that's unbelievable what that can do, because $1,000 over 40 years at 8% goes to $21,000. What happens if you put away $1,000 a year for 10 years and you're from 17 to 27? It just becomes phenomenal what that can do for you.
Yeah, we see that that time in the market, we've talked about, matters so much. I mean, even compared to a 25-year-old and a 35-year-old, that 10-year time period of that ability to compound is so great in those, when you start early. But you lose a lot of ground if you wait and delay and delay. Not saying that it's impossible, but it's a snowball going down a cliff. You're starting behind. There's another snowball halfway already rolling down the hill, and yours is just getting started.
I think a great point is if you invested $1,000 when you're 20 years old to get to the same place in 40 years, if you're 30 years old, you need to put away $3,000. Mm-hmm. If you're 50 years old, you need to put away $9,000. And if you're 60 years old, you need to put away $21,000 because you've already reached the point where you were going to be. But it's time and money, and the more time you have, the better.
I know I've said this phrase before, but it's absolutely one of my favorite phrases. Time in the market is way more important than timing the market.
Absolutely. Absolutely.
So as we talk about the power of compound interest, we're going to revisit this topic again, even though we did it in a prior episode. But the other thing that compounds is the thing that we're fighting against as we save for retirement, and that's inflation. Yeah. So, and we've really seen inflation take off over the last several years, and thankfully it's slowed down a little bit, but we're going to look at a few kind of things people might, in fact, let's just do it. Let's look at the McDonald's menu. We've got some examples of just what we've seen in McDonald's. How long are we looking at on this again?
10 years.
So over 10 years, a couple of menu items from McDonald's. Bob, you said you bought a lot of 10-piece chicken nuggets as a dad.
As a dad, yeah. I had about a 20-year window of those. And yeah, they were $6. Now they're $10.99 for the same meal.
And that's just in 10 years.
And there's probably 2 less fries. I don't know.
Yeah. Well, it's so funny. We didn't have this on our list to talk about today, but I find it such an intriguing thing. When we talk about inflation, and especially when it comes to food, there's the other piece of that, which is shrinkflation. So, one of the things that companies do is they might keep the price similar. Maybe it doesn't show as much going up for the packaging, but you find out that the product is actually much smaller.
When I was younger, I used to always go buy the Kleenex box if I needed a Kleenex, and I'd just rip that thing out. And it, and the box would stay there. Try that today. The box comes with it because there's not enough Kleenex in it to hold it down. I mean, and it'll do that from the second Kleenex you pull, and it wasn't that way when I was younger.
So same size box, fewer Kleenexes
That's
inside.
Right. That's right.
Absolutely.
Yeah.
McDonald's is a fun case study on inflation because you can go back a long time and watch inflation grow in the United States. You can actually see that with something that's very familiar with you and probably your family that, I know a lot of people have eaten McDonald's, their whole life, whatever. And I don't know, I remember going there and getting your value meal for $3.50 or $4.
Yep.
And, I'm 31 years old. So now I'm going to get my kid a Happy Meal. It's almost $10 now.
I'm going to give you a fossil story. First time I ever drove my mother to Topeka, we were coming down my summer between my 8th grade and freshman year because I had my driver's permit. And my mom let me drive to Topeka. And out on South Topeka Boulevard, west side of the road, there's still a McDonald's there today. It was the first one in Topeka. And I had never eaten at it and hadn't really ever heard of it. We drove from Onegan. We were going to White Lakes, coming down the boulevard. And we stopped there and ate. And my mom gave me $1 because she wasn't going to eat there. And I went in, and I got 2 cheeseburgers, the best French fries I'd ever had in my life, a Coke, and it was less. I got change back on $1. I remember the cheeseburgers were 17 cents. I think the fries were a dime back then.
Well, I'm about a generation behind you, and I can remember you could get 2 cheeseburgers for $1 at one point, still within my lifetime. But now, another great example off the McDonald's menu is the chicken sandwich. The McChicken is always on the dollar menu. You could get a chicken sandwich for $1, and that same chicken sandwich 10 years later is now $3. It's gone up 199% from $1 to $2.99.
And that's what's called identifying what people are eating and identifying you can get a grilled chicken sandwich, and I believe that's their number one thing from a health standpoint in their product line. And, people are buying that. Well, let's raise the price on it.
Yeah.
Supply
They're
and
very
demand.
smart people.
Yeah.
But biggest thing here with inflation that, we see all this. Well, how do we fight it? Well, one of the best ways that we believe fighting is through equity investing, being involved in the stock market, because the stock market is the great, what I'm trying to say,
Equalizer?
Yeah, the great equalizer. I mean,
Staying ahead of inflation.
Yeah, staying ahead of it, not really equalizing, but staying ahead of inflation.
One of my pet peeves about real estate, and I want every American to own a home. I mean, that's the American dream. And we've watched homes explode in the Midwest. We used to sit around and, I can remember living in Silver Lake in my mid-30s and going, gosh, I wish our houses would go up like they do in California, at some point in time. Well, now all of a sudden, we are certainly not California, but we've seen those 15% bumps. And it's terrible because it's pricing young people out of the market. And, of course, interest rates bumping up. It's tough. But, so for years I've had clients go, well, I'm going to, I own real estate, or I'm going to buy more real estate. And that's where I make my money at. And I've owned real estate, and I still do today. Does it make money? Yeah. It takes a lot of time. And I don't know about anybody else, but the property taxes that I pay on my property is stupid high. And when I look at what equities have, gee whiz, we have capital gains. Gee whiz, that's a tax break. Equities have qualified dividends, of which we get a couple of $100 a year tax-free, the first couple of hundred. Yep. Nobody's telling me that on my rental property. Hey, the first month's rent you have to pay tax on as income. So I think equities are where, if you talk to anybody that has money, and most millionaires have money in several different places, but they will tell you where they made the most money was either in a business that they owned, that generated them a lot of income, or in the equity markets of the United States.
Yeah, and as you think about retirement and risk, there's all kinds of risks that go into retirement, outliving your money, running out of money. But I think one of the greatest risks, if not the greatest risk, is inflation and the impact that it can have on your purchasing power. And as you said, Mark, one of the best ways to combat that is through equity investing.
Yep.
Absolutely.
Yeah.
And, when you invest in the market, we've already talked about, this is not a short-term thing. This is a long-term thing. But one of the benefits of that is that you're going to build wealth over time by investing.
Yeah, and the strategy that we would really try to tell people and to encourage people to use is dollar cost averaging. Like, if you're a 25-year-old and you're investing a regular amount, every month or every week, whatever it is, you are going to hit some market highs. You're going to hit some market lows. But you are not you're not trying to time the market. You are going to be continually actively engaged in the market, and your wealth is going to continue to build and build.
Yes, I have stories.
I was going to say, I'm sure you do.
We do a lot of work with school teachers, with educators, and I want to tell you why I like educators. They listen. They want kids to listen. Consequently, they have learned how to listen. I started out in this business in February. It will be 48 years. And how I started was going out and talking to school teachers. And back then, I talked about putting away $30 a month, guys. $30 a month. That was quite a bit of money. But it was probably the equivalent today of asking somebody to put away $100 a month.
Yeah.
But I would just say, let's get started. And I promise you I'm going to come by every year and visit with you about increasing that. Maybe you get a nice pay raise, and we'll increase it $15, $20, $30 a month. Or maybe we'll just increase it $10 a month. But I will come by and bother you every year. Otherwise, I will be your catalyst to come by and say, hey, it's time. It is now 48 years later. I don't have anybody in the industry anymore from that first year, but I still have them as clients. And they're between $800,000 and $1.2 million today because they increased every year. And they started seeing the value of saving. And probably the hardest thing to do when I was 26 was to have people, I'd say, hey, let's just start out there. And they'd look at me and go, well, you don't know what you're doing, and we don't know if we believe you. And I understand that. I was just a kid. But the ones that jumped on the wagon, that never saved before, got used to it, and they saw great years during that period, and they saw years where their money dropped by 30 or 40%. And I'd say, hey, just stay the course. Let's keep putting it away. And of course, over time, they got where they were putting away, some of them up to $1,000 a month. It's phenomenal what it can do for you, but you gotta, I hear Mark say this a lot, start where it's comfortable. Because, Joe, the worst thing that I can do to you is say, hey, let's invest some great big number that you might be able to do this year, but next year you don't know if you're going to have that revenue or not. What we'd rather have clients do is say, hey, I can afford $100 a month, okay? And I know I'm not going to ever have to call you up and say, hey, I need to back up on that. Let's start there. We'll help you bump it up as time goes by.
And I think that's a great point too, because, and you kind of already mentioned this, we're talking, when we talk about a hypothetical 8% return or that 10%, S&P average over the, last several decades, those are averages. There are ups and downs. Yeah. And that's the hard part for some people.
Since 2009, equity markets have averaged, the S&P 500's averaged 16% a year since the Great Recession. Have we had downs during that period? Absolutely. Is it going to average 16% going forward? Probably not. We can't forecast that. But what we can say is the last 100 years, equity markets have performed at 10% over time. Okay? That's the projection we use going forward. And also, that's the projection we use for the equity part of their investing. Because if you are taking money out of your investment, unless it's someone that's been with me a long time or with us for a long time and have built up huge dividends that take care of their retirement income, we have money in CDs and U.S. Treasuries to meet their obligations for the next couple of years, so that when the market has one of those takes the breath away moments, we're sitting there going, hey, we've got the cash to take care of your income needs. The market will do what the market does.
I read an interesting article yesterday about, one of the biggest trends in investing is, just buying the S&P 500 index fund and letting it roll. And, that's what we've talked about Warren Buffett, if you're not, working with someone that's, professional, he kind of says that's not a bad strategy. But the article is interesting because it was like these people, are the age is like around my age, where really we've only seen the S&P, do
Go
what
up.
it's done. So it's going to be a true test when we see maybe a market down fear for multiple years, and how many people can stay the course through. Hey, I've got to keep investing. There's time, not throwing that out the window, or So I think that is an interesting, the psychology of money, we really haven't seen the big downturn for some of our younger investors.
Last time that we had 2 years like the last 2 years was right prior to 1970. And basically from 70 to 80, the S&P 500 stayed flat during that period. Otherwise, it was like at 74, and it's still at 70. It was like at 78 10 years later. That doesn't take the power of compounding in there of the dividends that were paid. But people have to be prepared for that, because that happens. Mm-hmm. And the nice thing about that during that period, you stay engaged in the market, because if the market's down 5 years in a row, okay, that's a statistical anomaly. Right? That it hasn't happened.
Yep.
But if it is, I'm plowing into it because that probably means we're getting ready to have some good times coming forward.
And it's so interesting that you say that, Mark, because you're 31 and you talk about that generation that are investing. Down markets for them can actually be a great advantage because just like Bob said, you're kind of buying it on sale, so to speak. And then, Bob, you already mentioned it, for people that are more your age, where it could really hurt them, there's strategies involved to try to avoid having to sell at that point in the market.
We have to protect their income.
Absolutely.
Yeah, we have to protect their income. We do that with a portion of their money, like I said, either using certificates of deposits or U.S. Treasuries. We do not buy funds, bond funds. We don't. We can tell you why if you call. That we don't get involved in those because of a lot to do with expenses, but there's other things also. And when we do that, that takes away. At my age, I still work, so I have a salary that I get paid that I can live on. But if I was retired, I still keep a sum that if I need to get my hands on it and the market's down, I've got it there. I think it's very important.
And this kind of all leads to the end goal. The end goal is financial independence by the time that you retire. And, for different people, it's different ages that they want to retire at. But regardless of that, that's where the plan comes in. If you want to retire in your 60s, you need a plan for that. If you want to retire in your 50s, you need a plan for that as well. Yeah. But
I have a funny story here of just thinking about, living, having this financial freedom. And my grandma, I was talking to my grandma who's 96, and she was telling me about she could list all 15 of the stocks she owned, these dividend bearing stocks that, dividend kings pretty much, she was telling me. And she's like, and I haven't had to, I haven't, lost any, capital from my account. I'm just getting all these dividends, and it's paying my RMD, and it's doing this. And she was talking about how awesome her dividends were, and it's like, yeah, that's amazing, Grandma. And like, like she worked hard on that portfolio, and or whoever she worked with, and it's pretty cool to see, how exciting that is to see that she's protected her nest egg, and still is able to take money out and hasn't really, hasn't lost that,
And at 96 years old, she hasn't outlived her money.
Yeah.
Which, AARP had Kiplinger had an interesting article in this month's magazine. You got to prepare for 40 years, not 30. Mm-hmm. It's changing right before our eyes. And, I used to go to funerals for, and certainly there are people that pass away at a younger age. But more and more, when I go to a funeral, it's 89, 94. The guy that trained me in this industry is 100, and still as sharp as a tack. And it's just different. And he's been retired since he was 70. So he's had a 30-year retirement.
And retired late.
And retired very, very late. And that is a great story about your grandma. I hope she has her statements so you can kind of go back and see the history of that at some point in time. But my brother wouldn't mind me talking about this. He told me one time when I started managing his money, which he's 13 years older than me, so he didn't trust me. When I was early on in the career, when he gave me his money, he said, the only thing I want is as I age, I don't want to lose number of shares. And I thought that I've used this a lot. I think it's very interesting. He said, I want to own the same number of shares at the end of every year. I don't care. I know that we don't know what the market's going to do, but I want to own the same number of shares and be able to live off the dividends that those generate. And of course, as Mark knows and Joe knows, that's my whole portfolio. And I'm not going to share with what my dividends were last year, but my dividends far exceeded my Social Security, which is pretty good, and that's pretty neat.
Yeah, that's great. But one of the things that was important, though, and it's really kind of important for any investor, is being able to preserve that. And a diversified portfolio moving into retirement is pretty important for that, wouldn't you say?
Yeah, I mean, we're going to try to generate income. We might do that in some different ways. We're going to keep some more cash on the sideline than probably when you were working, but
Yeah, a client that, let's say an aggressive client that last year made 25% and they're 30 years old. A 75-year-old client with the exact same portfolio with us is going to make like 17% because they're going to have 20% of that portfolio is going to be in fixed income. The rest of it's going to look like that younger investors. But I think one of the key things we do is that's what we do for everybody.
Right.
Yeah. Otherwise, we don't have a different model. We work the same model, and then we take care of risk tolerance by the percentage we have in equity, which makes us different.
So very important that as we kind of bring this episode to a close, we talked a little bit about why it's important to invest, the power of compound interest. We talked a little bit about inflation, kind of the greatest risk that comes along with retirement savings. And then, obviously we've talked about diversified portfolio. Really the bottom line here is if folks are wanting to get started and they feel a little uncomfortable doing it on their own, they can get a hold of you guys. You've got an office in Victoria. You've got an office in Silver Lake, which is where we're recording this today. The best way to do is reach out through the website, wouldn't you say? BobSchwartzFinancial.com?
Through the website or 785-582-5805. Leslie, Julie, Mark, or I will answer the phone and we can start talking. We do not charge to sit down and talk with folks. We go anywhere in the state that people want to see us. We've even been known to go out of state. But we're here to help, and I hope that what we do here helps somebody that we might not ever meet, but helps them get started on that path of getting a little money put away for their later years.
And having some financial independence.
Yeah, perfect.
All right. Well, gentlemen, thank you so much. I haven't said this to you, but Happy New Year. Yeah, and hope all of our viewers and listeners.
This is the last day you can do it.
Yeah.
I heard that this morning on the Mike Patrick show, Dan Patrick show.
Last day for Happy New Year's.
Yeah, it's the last day you can say it.
It's the 3rd, by the way, when we're recording this. But happy 2025 to everybody. Once again, just a couple reminders. If you are enjoying the information that you're getting here, we ask that if you're on YouTube, give us a thumbs up. And, of course, subscribe, hit the notification bell, and give us a review on the podcast if you're listening on Spotify or any other location for podcast. And with that, gentlemen, have a great weekend, and everybody else, Happy New Year.
Awesome. Happy New Year.
Take care.